So now I'm going to introduce Greg Friedman, Managing Principal and CEO of Peachtree Group. You probably see him on CNBC. It's a commercial real estate investment firm which specializes in acquisitions, development, and lending. Since co-founding Peachtree Group in 2007, Greg has successfully overseen investments of approximately $10 billion in CRE and various enterprises. I'm going to leave it to him because we're running a little bit behind now. Take the mic. Thank you.
So I'll try to be relatively quick. I know we're behind schedule, and I know a lot of people are probably tired, so I want to try to, at least have somewhat of an engaging discussion. I know there's been a lot of data thrown at you, a lot of really good data, a lot of good presentations. And what I really want to talk about today is, what inning are we in? Like, this is a question I get all the time as we're out, raising capital. People are always, because we're a fund sponsor, and I'll talk a little bit more about who we are too in a minute, but as I'm talking to people really want to understand what's happening in commercial real estate, what's happening in hotels, especially the credit markets and the equity markets as it relates to real estate. So I think there's some interesting data points out there that sort of shows where we are, and it sort of points to why we're focusing as a company on the different areas that we are focusing on. With that said, my company, Peachtree, I co-founded, started the business in 2007, and we're set up to go out and invest across commercial real estate and hotels. So we invest, both on the equity side, where we go out and acquire and develop assets from the ground up. Our equity strategies tend to be very hotel focused, across select service, limited service, extended stay type hotels, mostly branded hotel properties. On the equity side, we have some full service hotels, but primarily it's select, limited extended stay hotels. And then on the credit side, we're very diversified across all commercial real estate property types. We have a pretty large commercial real estate book that pretty much covers everything from multifamily to industrial, retail, hotels, and so forth. We are vertically integrated, so we own different companies that are set up to operate, develop, lend, asset manage across commercial real estate, and we have obviously a hotel operation platform that's probably a little bit more relative to the discussions here today, but we do have platforms that do other stuff within real estate as well on the operation side. With that said, as a firm, we've made over 700 investments. Over 500 of these investments have been on the credit side of the business. So we're very active in being a direct lender. We're very active in, when you look throughout time, we bought a bunch of debt during the pandemic, bought a lot of debt during the great financial crisis. These were primarily first mortgage loans that we acquired. And we took advantage of those moments of distress, especially with like regional banks and community banks. We were able to go and buy those loans with the idea of really restructuring those loans with the borrowers and keeping them in place and really serving as a lender or a soft landing spot for these borrowers. And we've had a lot of success where over 97% of the loans that we've acquired have led to us just restructuring and keeping the borrower in place. So we're not a loan-to-own shop. We're truly a lender that's looking to service the borrowers that are the owners of these assets. With that said, as I said earlier, I think it's really interesting just looking at what inning we are in real estate, because there's a lot of things that's happened over the last couple of years. Going back to the first quarter of 2022, values really peaked across commercial real estate. I'll show a chart in a minute just showing the different value declines since then, and it's been very uneven across different property types for a lot of the reasons you can imagine. They continue to just be a lot of volatility in the marketplace. There's a lot of risk, we believe, in the market still on the geopolitical side, not to mention just with the upcoming U.S. election. And you've had just, a ton of just, loan maturities. And a lot of these loan maturities are getting pushed into, basically extend and pretend by a lot of these banks. So they're getting pushed into 2025. Some of them are getting pushed out to 2026. And you have like an unprecedented amount of loans that are maturing in both 2025 and 2026. That's going to present a challenge as well for real estate. And we've had a lot of maturities that have presented challenges recently as well. With that said, the property values decline. As I mentioned, it's been uneven across the different properties. Commercial real estate in general is down 20%. Office is down on average about 37%, which it's down mostly because of that secular distress, because office is just facing the challenges of people needing office space. But then you look across all the other property types, it's really the reason pricing has come down is because of that balance sheet stress. It's because of the impact of higher rates across the real estate assets. So the higher interest rates are impacting negatively the values of assets. Hotels have had less of an impact, just given the fact that hotels are less sensitive to interest rate movements because they trade at higher cap rates. So in general, as rates have gone up, it's not as punitive to the underlying values of hotel assets, but that's not the case across multifamily, which by far has been probably the most favored property type outside of industrial across the commercial real estate ecosystem. And there's a ton of capital chasing both those assets, yet multi is down well over 20% from peak values, and that's really a function of just higher rates. I talked about just the wall of debt maturities, and between now and the end of 2026. I mean, this chart I think shows that we have over well over $2 trillion, but it's close to $2 trillion just between now and the end of 2026, and that's a lot of loan maturities. Roughly about 10% of that is hotel assets, and so I mean, there's a lot of hotel assets that are going to face loan maturities, and when these loans are maturing, these were loans that were originated in most cases pre-2022, so they were originated in an environment where SOFR, you look at the federal funds rate, it's probably a better example because it usually follows SOFR to a certain degree, but it was closer to zero. On average, the federal funds rate pre-2022 for that decade was closer to 75 to 100 basis points on average, and obviously the federal funds rate today is well over 4 times that. Rates are coming down. We have a view that when we look at the federal funds rate, it's going to stay higher. But that's going to present a huge challenge as these assets with loans that are maturing, they're going to have to face a much higher debt service expense in order to refinance those assets without injecting additional capital. The transaction volume has been really muted, and obviously Kabani probably could attest to that. Just there's less, there's really just a lot of pricing discovery challenges. We see it when we're out there trying to buy assets. We see it when we're trying to sell assets. There's a huge gap in pricing. And that's presenting a challenge. And I think a lot of that's driven off this view of where interest rates are going to settle long term. And because there's differing opinions, that's really the disconnect. In most cases, the assets we're selling, they're good assets. It's just us as a seller, we tend to think the values are much higher because we may have a different view of where future cash flows could be, but more importantly, how we view interest rates and what long-term rates could look like. Just from the standpoint of the hotel industry, the big catalyst I think on a go-forward basis is just the lack of CapEx spend. CapEx spend is down over 50% from the start of the pandemic, and so you've got close to I think $20 billion of deferred CapEx projects, and that's going to be a huge catalyst to help spur the transaction market. I think in the near term, along with this wall of debt maturity. So I think that's a factor that's going to benefit anyone that's looking to make new investments, anyone looking to go out and buy assets. I think it's going to present an environment where you're going to be able to find buyers that are motivated to sell assets. Just from the standpoint of just supply and demand in the lodging business, I think one thing that is sort of interesting because we look across all the different property types. Multifamily is dealing with a record amount of supply that's being delivered. And demand's obviously been a little bit, although demand continues to grow in multi, but it's having to absorb all this supply, and it makes it really tough to drive rents in that space. Hotels is a little bit reversed, and on a go-forward basis, supply and demand is very well positioned. Like demand is continuing to grow in the out years. When you look over the next 5 years, we believe demand is going to continue to grow close to historic averages, which demand historically is growing at about 2% a year. And supply, just given the challenges in the debt markets, given the challenges coming out of COVID, supply we believe is going to be pretty muted and probably be probably a good 30 to 40% below historic averages, where supply historically grows at about 1.6% a year, and we think it's going to be 1% or less a year. The 10-year treasury rate, I think whatever you take away from today, like your view of values, this is one of my, this is the slide that we focus on internally a lot, just because if you look at the 10-year today, it's at roughly about 4.2%. I think it pulled back, this morning, so it's around 4.2%, which is substantially higher than where we were that decade pre-2022. So it's double effectively where we were when you look, from 2022, first quarter 2022, that decade, that 10 years beforehand, the 10-year average closer to 2%. It was around 2.2%. So this is a huge headwind if the 10-year stays higher. So even though federal funds rate is coming down, and I do believe it's going to continue to come down, this is going to be a challenge to how assets are valued, because most cap rates typically, when you look across all commercial real estate property types, hotels included, there's a risk premium spread that's applied to the underlying assets. And so if it's on average, commercial real estate trades about 275 basis points above the 10-year treasury rate, being the risk-free rate. And when you look at hotels, typically trades at a little bit higher, good, call it 100 to 200 basis points above that typically, because hotels are viewed as a riskier property type. And so if the 10-year stays elevated, that's going to put upwards pressure just on cap rates. And if the 10-year comes down, that's going to allow for cap rates to start to decrease across the different property types. So this is a big factor. And when you look at where the 10-year is today relative to where we were during the great financial crisis, you could argue that we've moved back into that that era. So we're really in a pre-GFC environment from an interest rate perspective, which is somewhat interesting as you're looking at valuing assets. The question a lot of times I get is how we hit bottom, and I think we're probably closer to the bottom, but there's also a lot of arguments that we could have further deterioration of values. I mean, there's a lot, as I mentioned, there's a lot of geopolitical pressure. We have this issue with the 10-year treasury rate being elevated. That's going to provide a lot of challenges, I think, over the next 12 to 18 months, depending on where the 10-year does settle long term. And if it ends up settling closer to 4%, that has a totally different impact than if it pulls back into the around 3% or whatever the case is. That is going to impact the underlying values of these assets, because it's not to say values can't grow, it's just you're going to have to grow cash flows even more. So there's a lot of challenges that I think that are going to create in the near term potential challenges where values could come down even further, but we're probably closer to the bottom than not at this point. Just from our standpoint, because I think somebody mentioned earlier about soft landing, and we're headed towards a soft landing. I think when you look at what Powell's done, he's done a really good job sort of navigating us towards this soft landing. But this soft landing is not necessarily a good thing for real estate, because it's going to be it's really the catalyst to keep rates higher. So the Fed's not going to have, like when you look at the past couple of cycles, the Fed's been able to reduce rates dramatically because we go through a great financial crisis where you have some type of black swan event that creates a lot of pressure in the financial system, so they have to drop rates down substantially, and we just don't have that catalyst as we look at the market today. And that's a challenge that we have to sort of think about. If rates don't pull back, that's going to be a huge challenge as where do you invest capital. And so we're very focused as a firm right now, looking at buying assets where there's a heavy value add type case there for that asset. We're also very much focused on development, which is somewhat contrary to what you would think we would focus on today, but development in our eyes, just given that supply is muted, is a good place to play. And then you look at just credit in general. We've probably 75% of our book today is focused on going out and just doing direct lending, because we feel like that's the best place to be just from a standpoint of allocating capital. So, at the beginning I was like, what inning are we in? And I would argue that we're really in a new game. Like it's not really fair to look at what happened over the last decade, because going back to 2022 and pre-2022, we were in this 0% interest rate environment. And our whole view is that we're not going back to that environment. So we're going to be in an environment where the federal funds rate is going to be probably 3x where we were. We're probably going to end up with a 10-year treasury rate that's substantially higher by a good 50%. And so you really can't value assets based on what was happening pre-2022. You've got to look at this new environment based on where rates are. So thank you for your time. And if you ever have questions, please don't hesitate to reach out. I just want to say thank you to Kabani for having us as well. So thank you.